Tesla, a rare favorite among both retail and professional investors. The company has a market value that dwarfs the rest of the industry. Despite volumes that still leave it well outside of the top 10 producers. Obviously, some big hopes are baked into the story, but how is that translated into the operational success of the business? Well, in this video, we're going to run through what Wall Street thinks about Tesla, how rankings and target prices have evolved, how the company has performed versus earnings expectations, and what the current estimates are for growth and profitability. And finally, how that valuation stacks up with the peer set. So, let's get into it. To start, we have to acknowledge the incredible growth that the company has had to date in growing its production. The company has averaged annual revenue growth of 54% since 2015, back when the company was just a novelty. This includes 118% growth during the course of the pandemic, while the rest of the industry struggled just to keep production online. Target prices for the street have typically lagged the stock, but have kept up quite well, consistently marching upward since 2019. More recently though, target prices have caught up since the company's peak in 2021. In fact, over the last 2 years, the targets have been higher most of the time, but the era of big, consistent gains appears to be waning. And despite the street showing some reticence on the target price front, they do appear to have consistent faith in the company, with typically between 70 and 80% of analysts rating the company a buy or a hold. Consistently missing from this list though is JP Morgan, but that's a different story. Despite astronomical growth, the constant impediments and setbacks from scaling in such a massive production front, and a brilliant but aloof CEO, Tesla has been surprisingly consistent with regards to hitting Wall Street estimates. Over the last 25 fiscal quarters, the company has only missed revenue estimates 6 times. And if you ignore the factory delay late in 2019, all of these events have been relatively minor enough to get a passing grade from the street. Moreover, the company has typically posted shockingly strong beats consistently. Elon Musk's reputation for overpromising and underdelivering with respect to the future apparently doesn't hold up on a quarter-by-quarter basis. And this extends to the earnings front, where amazingly the company only missed 1 quarter during the whole of the pandemic. Damn. So, is the growth party over? Nope. The street thinks Tesla has years of incredible growth left to come. While lower than the 50+% since 2015, Wall Street thinks Tesla is going to increase top line by a compound annual growth rate of 31% over the medium term to 2024. Within that is continued strength from the automotive division and even stronger growth from the energy generation and storage group, while the other category is much more muted. If the street believes in some of the other crazy side hustles Tesla has cooking, like the Tesla robot, it's not yet factored into the estimates. And this growth means that Tesla will find itself cracking into the top 10 automobile producers on a unit basis very soon, with cars likely closing in on 5 million units by 2024, compared to less than 1 million in 2021. Damn. Through this, Tesla's operating leverage likely means that EPS will outpace revenue growth, with the street currently expecting annual revenue growth of nearly 40% until 2024. And you can see this operating leverage building here in the EBITDA margin, as the street sees the company adding over 500 basis points in just the next 3 years. How a trillion-dollar company can do this is simply astonishing. And what makes this even crazier is that it's not like Tesla's coming from the back of the pack here. The company already has one of the best margins in the industry, with only Ferrari ahead of them. And it takes them having average selling prices in the $300,000+ range in order to do it. Also impressive here is that these estimates aren't static. They rarely go down, but often have gone up considerably. Take for example Wall Street's estimate for 2024 revenue. In April 2020, the street thought 2024 revs would come in at around $59 billion. But after increasing expectations around adoption and production, the street has more than doubled this estimate to $132 billion. The same goes for earnings per share, where over the last 2 years, 2024 EPS estimates have tripled. If this trend continues and Tesla continues to execute, we could be in store for more incredible upgrades on the operational outlook. Anyway, it's clear that Tesla's growth has been amazing, and they have continued to make Wall Street's estimates look outdated. But is it a good investment? Well, that's not really why I'm here. But the obvious point of contention is how outlandish the valuation is compared to its peers. Tesla currently trades at around 67 times next year's EBITDA, roughly 7 times the average of the peer group. So, it's a matter how much you're willing to pay for that growth. Tesla is expected to outgrow its peers by nearly 15 times over the period of 2019 to 2024, and that's assuming estimates don't continue to go up. And while a lot of people still have it in their heads that Tesla is just some small niche player with limited long-term mass market appeal, that just isn't the case. As we've pointed out above, expectations for Tesla are closing in on being a top 5 player in only a few short years. And to date, this has really only come from sales of 4 different cars. 4. Well, okay, 5. Stellantis, the hideous merger of Fiat Chrysler and France's PSA Group, has more than twice that number in brands alone. And that matters, as it speaks to the broad appeal of their vehicles, and also the greater production efficiency from not manufacturing 100 different kinds of mediocre sellers. And while I've never been so bold as to call Tesla stock cheap, on a pure forward EV to EBITDA multiple, it's definitely a lot less nuts than it has been. So while I can't tell you it's the perfect time to buy Tesla, things definitely look a lot better than they did a year ago. Alright, so that's my quick take on what Wall Street thinks about Tesla. If you have any suggestions for what company I should do next, please let me know in the comments below. And please hit that like and subscribe buttons for more informative and hopefully entertaining financial content. I'm Ryan, and thanks for tuning into Market Lab.